Hi, everybody. Azid from Quiddity Property Education. This is season 2, episode 2. So if you've missed season 2, episode 1, where I was talking and I spoke quite a lot about HMO, and I gave a very good account of what HMO as a strategy is and how it works, go back and listen to that if that's a strategy you're thinking of in 2025. In this episode, I'm going to talk about leveraging. I'm going to talk about borrowing to make money and why that's important. It sounds so obvious, but I would like to share with you the mindset that people need to have so that they can actually change the way people invest. And I'm going to start with myself first. So let me give you a quick summary of how I used to think about leveraging. I used to not like it. I used to be quite scared, specifically around bridging, for example. It was a type of borrowing I used to be quite scared of because, like everybody listening to this podcast would probably vouch, you've heard some really terrible stories of bridging where people have bridged and then failed and then ended up losing their property that they bought or owing more money than they've actually borrowed. So those things scarred people for a while, and myself included. So in this episode, I'm going to talk about the idea of using finance to exponentially increase your property portfolio, and what I've been doing over the last 5 years or so, and also more importantly, how I'm coaching my mentee on a one-to-one to then also use the same strategy to exponentially increase their passive income and their property portfolio. So what is leveraging? Well, actually, typically it's just borrowing, right? So you're using bank money to help finance property purchase. Think about leveraging and property as an amazing compounding feature, because you can, I guess, leverage a little bit to buy shares for a very short period of time, and you can short or you can long shares. But with properties, actually, the bank is more than willing to collateralize their money against the asset you're buying. So typically, when how leveraging works is you will use a mortgage. Like most of us have taken residential mortgage or buy-to-let mortgages. You have 25% deposit and 75% loan-to-value mortgage, and that 75% is what the leveraging is. How does mortgage works? We're going back down to basics. Where mortgage works, basically, the bank will charge you, let's say, 5% to borrow the money from them. They're probably borrowing it for 3.5%. So that's their margin. And we need to make sure that what we are borrowing it at is less than what we're going to make in on the rent. So typically, if you make a rent of £1,000, your mortgage around £500, you are making a profit of £500. And that is how you use leveraging to make a profit. The more you are able to then increase those £500 and the amount of £500 you make, the easier it becomes for you to build your passive income. So why is it good? Well, quite frankly, you need less money to buy a £300,000 house. Imagine if there was no leveraging, you'd have to find and save £300,000 house to buy the average property in the UK. With leveraging, you only need 25%. So you need £75,000 to buy a £300,000 asset. The other thing that I've talked about, why is it good? Because you can build your portfolio much quicker and much faster by using other people's money. Why is it so the disadvantage of leveraging? Well, quite frankly, you are borrowing, you are putting yourself in debt, and debt normally means risk. But ultimately, if you're taking calculated risk and you're buying an asset that's worth 300,000, typically I will only buy a 300,000 pound asset below market value. So I really be paying around 200,000 for it before I can then commit the money. So if you're doing below market value purchase and then adding value to it, the risk is significantly reduced. Interest rate is also a potential challenge for when you're borrowing, because if you're not fixing, you are open to swings in the interest rate. So if you remember 2021, when Liz Truss crashed the economy, the base rate surged, and all of a sudden our borrowing rate went from 3.75 to 7%. So if you weren't on a fixed rate, your mortgage would have doubled overnight. So that's the risk of actually leveraging. How do you manage it? Well, actually, every property that I buy and when I refinance, I take my money out and I leave them on long-term buy-to-let mortgages. I fix them for 5 years. It doesn't really matter how the economy is doing or what the interest rate is doing. I can't guess in 2 months' time or 2 years' time whether it's going to be 5.5% or 2%. What I can do is I can make sure that my rent covers my interest-only mortgage today. And if it's covering today and I'm making £300 a month today, then I'll fix everything for 5 years and I don't come back to you for another 5 years. Why? Because if you fix it after 2 years, you have to pay your broker fee, the lawyer fee, the survey fee, the arrangement fee. So the saving that you think you're making by fixing for 2 years at a very marginal savings on interest, you end up giving back. So it's a false economy in my view. That's why I coach people to really fix for 5 years, and I do it myself also. So who does it suit in terms of using leveraging as a strategy? Well, quite frankly, it's about your mindset. It's about you need to be able to understand risk, take calculated risk. So buy something that's 300,000 at 200,000 and add value to it. So that's your calculated risk. So even if the market did have a downturn temporarily, you are not going to be in negative equity. And also the mindset is about borrowing to invest, not borrowing to buy Ferrari, borrowing to buy an asset that's income producing. So in that way, you are leveraging for your benefit. And as long as your rent covers your mortgage, you are going to be in a very good shape. And if you do that multiple times, you are able to then recycle and take that money over and over again to borrow more money and buy more units. So in terms of leveraging, I will leave it there. So if you've got any questions, you can leave it in the show notes. You can DM us, you can email or go to the website. But I want you to understand that to grow a business, you've got to get comfortable with leveraging and borrowing money. You've got to do it in a way that's calculated risk. And actually, you are able to then grow your portfolio by taking those risks. In the next episode, I'm going to talk about the SDLT changes and what that means for us and how we could actually be using some of the knowledge that I teach on my one-to-one course in our advantage.